Welcome back, everyone, to another Market Open live stream. Let's go ahead and take a look and see what the heck is happening to the market today. First thing that I thought was really interesting is yesterday we saw bonds fall a little bit, and that led yields to rise, which I thought was really interesting because of all the drama regarding Pelosi. And today, even though Pelosi's left, and that's leading the stock market to go up, we're also seeing yields go up again. Remember, yields going up is critical, specifically because it means real estate has more risk longer. The best thing that could happen to real estate, absolute best thing that could happen to real estate in this market, is we see interest rates plummet. I kid you not, real estate is so simply correlated to rates. It's beyond overly simplified. And so the fact is right now, we're back at 2.8%, 2.792 on the 10-year Treasury. And the 10-year Treasury tends to move with mortgage yields. They're separate, but they tend to move together. And we're seeing it rise again from this low that we got to of about 2.59-ish. This is interesting, though, because it's also before two larger economic pieces that are coming out. One, we have CPI coming out next week on the 10th. That's going to be big, especially since expectations are that the CPI read is supposed to come in low, which is really, really interesting that the market is now expecting such a U-turn from going from a high CPI read to a low CPI read, which is a problem because if the market is expecting that, it's easy to miss. It's a lot easier to miss. So low CPI is going to be very interesting. That comes out 1 week from today. On Wednesday, we have the jobs report coming out on Friday, but that's going to be critical in terms of watching the real estate market. I also, and I think this is very interesting, I've already seen real estate inventory 2 to 2.5x in my city. And my fear back in January was, oh my gosh, there's like no inventory on the market. And everybody's like, Kevin, prices can't go down because there's no inventory on the market. And then what happens? When I'm like, well, I'm going to sell before inventory does go up because it will. And sure enough, now it's up to almost 3x in some areas. It's really crazy. Anyway, good morning. Thank you so much for being here. Appreciate you. MNT, appreciate you in the comments there. Okay, so welcome V1M. S0 for being another chat member here. Okay, so let's see what's going on in futures. In futures pre-market right now, we've actually got a pretty solid green day. Dow up 0.5%, S&P up 0.58%, and the Nasdaq futures up 0.6 with no futures given yet for the Russell. That usually do that, but I think let me see if I can get pre-market. I don't know why people are so anti showing pre-market for the Russell, but yeah, okay, there we go. I got the Russell via ticker UWM up 161. So this is great. I mean, it doesn't surprise me because we've got some fear leaving the market right now. Remember, personally, I'm 96% long on this market, and the rest is cash, cash that I'm getting ready to throw into the Series A. In fact, they've got the PPM right there. I still got to go through the darn thing, but it's so long. It's like, I mean, it's fine. I'm going to have like a little highlighted version and stuff for people so people can see like the good stuff and stuff, but anyway, I mean, I guess that's not that bad. It's probably like 90 pages. Anyway, getting closer. Okay, folks. So looking at some individual tickers here in pre-market, and let's see what kind of news we've got. So pre-market, PayPal really doing well here, about 14%. I made a short little 3-minute video yesterday kind of going through the fundamentals of PayPal. Ordinarily, I just do that in the course member live, mostly because it's a little bit more nuanced, but then we can also have a dialogue with course members about it. It's really kind of interesting how we fish that information out. So that's kind of fun. We have SoFi Technology kind of moving up 12.3% as well, which is great because yesterday when we got those earnings on the triple beat, I'm like, why is this not up to at least 10%? This is an amazing report. And now it finally is. So we'll see how all these things behave when the market opens. But I mean, look, SoFi is $7.20. It's incredible. What I do want to look at quickly is let's see if I could get SoFi's press release on earnings here. So we usually can't get their actual 10Q just yet, which is kind of annoying. But it would be interesting to see. I know they still lost money, which is a little bit of a bummer, because once they go profitable, I think this stock really has some potential room in it. You can see it here. They had a net loss of about 12 cents, which they've narrowed from about 48 cents, which is really incredible. But and what was the member growth? How would they do over here? Great. Wow, that's actually phenomenal. So I mean, the amount of what is this? That's four. I'll just do the difference really quick. That is 4319 divided by 3868. I'm surprised they grew members at a 12 or 11.6% clip, despite how challenging it has been to attract new customers. And one of the things we talked about yesterday in the closing live is we wanted to see what kind of potential allowance for doubtfuls they had. And so we should be able to see that over here. Oh, yeah. And also, were they able to ever go profitable on tech? That's right. And the answer to that question is no. Still spent about $100 million on technology and product development, brought in about 81 mil. This is like what we saw Sam Bankman-Fried yesterday say, that it's just not profitable to run a stock brokerage with no commish in this sort of environment that we're in. Okay, looking towards the downside. Do we have any downside stocks here? Yes, we do. Solar Edge. Wow. Solar Edge down 9.3%. Airbnb down 6.77. Ouch. Now, obviously, a lot of these companies have really moved off of the bottom. Is it picking up the computer? Thank you. I need to. Oh, you're right. Good call. Good call. Thank you very much. Fixed. Very good call. I need to just, every time I open this up, apparently, you'd think it would like save as default, but it doesn't. So yeah, no. All right. Fixed. Thank you very much. Okay. So yeah, thank you so much in the comments here. I see you. Okay. So Airbnb, Solar Edge. Now these guys have moved a bit. Let's pull up the chart here together. So let's go look at the day chart here. I mean, Solar Edge has had a nice little run over here, and we definitely see, I mean, gosh, look at this. We've been trading sideways on Solar Edge, anywhere between 344 and a low of like almost 200. Wow, in May, that's incredible. 208, 200 over here in January. What a wild ride. So really seeing this down 9% to 331. It's going to be a nice big red candlestick. It'll drop to about right here where the mouse is. But, that's still dropping to the high levels of March over here. Yeah. So we are seeing that we're getting kind of back to that world where it's like, oh yeah, the bottom's behind us. The big test that I want to see today, now that Nancy Pelosi is done messing around in Taiwan, I want to see us really break 318 on QQQ and then hold it. For me, that would be the dollar signs. So we'll see. We will see. All right, let's go ahead and take a listen on over and see what we got over here on the CNBC.
Jim, talking about China, we were talking earlier about Starbucks, which has a huge business in China. Revenue and profit was actually came in better than the market expected broadly for the company. Of course, still hit by China. What's your sense of Starbucks? I mean, I actually thought it was a pretty good earnings report and potentially sets them up for a better situation than some people had expected this quickly.
I think you're even as correct as you are. I think it's even better than that. I think the day part's terrific. China comes back. It'll be amazing. United States was good. I met with Jeff Marks this morning for the Charitable Trust, and we said we had to consider Starbucks in the mix. We're going to go more than that in our morning meeting, simply because it was just such a stellar quarter. And also, of course, because, Howard's back, and Howard Schultz orchestrated an amazing conference call that made you feel like that this is the beginning of the next act. So I agree with you.
Okay. Well, Jim Cramer, we will see you in just a couple of minutes.
That's it. We're not going to talk about other cool stuff.
There's so much cool stuff to talk about, but I need to save time for you to start your show on time. That's what I'm trying to do. Squawk's coming right back. We got Jim Bullard for just a moment right before.
Great. We got the Fed coming on to CNBC. Oh, they're always fun. What do we have? I think we actually have a few Fed speakers today. They love talking this market down. I tell you, it's quite hilarious. As soon as the market goes green, they start panicking and they talk the market down. It's quite interesting. So we have on tap for today Bullard, Hawker, Daly, Barkin, and Kashgari. Nice. All of them. Yep. Talk the market down. All right. So what else do we have today? Well, let's see. We've got so Pelosi again out of Taiwan. We did have Putin respond, which I thought was very interesting. Putin and the Kremlin said we should not underestimate the level of tension that has been provoked. That's it. It's like, okay, whatever you say, Russia. We've got another Solana hack, apparently. Let's see what this is here. So Solana, once again, I don't know why. It seems like they always just get whacked. My goodness, constantly Solana. Hackers targeted the Solana ecosystem early Wednesday with thousands of wallets affected in the latest hit to the cryptocurrency market after the Bridge protocol Nomad was attacked. And damages are somewhere between, or estimated around 5.2 million from 7,900 wallets. Interesting. 4 Solana wallet addresses drained approximately 8 million from victims. Okay, so up to 8 million. So there's a little range right now. Since Solana down 7.3% to about 38.40, lowest in a week. Bitcoin up 1.5%. Crypto projects proving a rich vein for hackers. And the industry has suffered numerous attacks this year. Solana's woes come after Nomad, a bridge protocol for transferring tokens across different blockchains, lost close to 200 million in a security exploit on Monday. Oh, wow. Much remains unknown at this point. It's just sad. You know, people are trying to invest and invest in a technology that they believe in for the future. And then you get all these hacks and scams. You know, it's one of the reasons that we disabled the actual comments on videos is I would probably spend every single day anywhere between 90 minutes to 2 hours. And this would be like segmented up into like little 10-minute batches. I just have this like addiction of going in there, going to the little YouTube studio, going to the little comment section. And my goal was I would scroll down and I'm just looking for has replies. And then 9 out of 10 times has replies to comments, scammers. Like here's one right now. Awesome, your potential seems limited. I've always been fascinated with investing and need to start now, starting with $50K after. What sectors do you recommend? And then it's all just like, oh, contact this person. Oh, hit this person on WhatsApp. It's so bad. Like, I mean, it is the scammiest corner of finance. That doesn't mean it's bad, but it's quite disgusting. And so now I don't have to worry about that anymore. All right. So let's see if we get Bullard. Where's Bullard? Because I think Bullard's coming on.
So it may give you a signal that you need to be more concerned about a wage price issue in terms of inflation being sticky. But maybe it goes away eventually when people come back.
They can ask for more money by saying, I want the same amount of money, but I want a lot more flexibility.
So that you don't see that. So that's not
happening.
something you need to be concerned with as much.
Well, to an economist, that's an increase in the wage. You know, you've changed the nature of the work as to be the same as if you went to a 4-day work week, but paid people.
So that's a problem for the Fed then.
You know, the wage price spiral, I'm not a big advocate of that. I don't think that's not the driver of inflation. That's a symptom of inflation. Of course, companies have to keep up with the market. And of course, workers want to get the very best that they can.
All right. Thank you again.
All right. Thanks for being here.
All right.
Thanks for having me.
Fantastic. Final check on the markets. Last I saw we're up 200 on the Dow, 198. And you can see the net.
That went quite fast. I do have some more of the insights because this is actually a second interview today. So he previously mentioned he favors the strategy of front-end loading with big interest rate hikes. He's a big fan of ending the year at 3.75 to 4%. That's a little bit stronger for a terminal rate than the market might be expecting. He does say we still have some ways to go to get to restrictive policy. So one of the things to remember is right now, Jerome Powell told us we've achieved neutral. Now the goal is getting to restrictive. And I think that change from neutral to restrictive is pretty interesting. And the level at which we need to get to is going to be something that's watched by the markets very closely. Jerome Powell seems to be a little bit more in favor of what the last SEP showed us, which the last summary of economic projections, I would pull up right now. Last month, let's see here. I want to say it was about 3.5. Yeah, we'll go with that. It's just not worth taking the time to find it right now, but it was right around 3.5 to 3.6. So Bullard, a little bit of a fan of going a little. Oh, there it is. Okay, it was actually 3.4 at the end of this year. Found it. Perfect. Okay, 3.4 was on the SEP for 2022, and then the end of 2023 was 3.8. And then, of course, he sort of reiterates what we've seen from the Fed before, that it is time to see some broad-based declines in both headline and core inflation coming down. But he also says we're not in a recession right now, which is quite interesting because I'm pretty sure, based on a technical definition of recession, we're in a recession, but everybody wants to call it something different. All right. Facebook looks like weighing a bond market sale. Bond sale. Raising money. Got to raise money to throw more money into the money-losing pit of virtual reality. Oh, man. Does not look like we have an idea yet. Okay, here we go. Meta could build a new capital structure that includes its first ever bonds issuing well over $10 billion to potentially benefit holders of both equity and debt. Right. Well, I mean, initially you dilute, but then the idea is it gives the company more cash, and hopefully they should be able to do something with that money. Unless, of course, they burn the money. I don't know. That's going to be interesting. Someone writes, when the solar flare hits, you'll be glad you bought gold and silver. The solar flare. Oh, here's an interesting piece. Insiders are dumping at the highest rate since January. Senior executives in charge of America's largest corporations are among the most skeptical of the S&P 500's rebound, as the 500-member index, the S&P 500, posted its best month since 2000. Corporate insiders continue to sell their shares at a faster pace than they bought them. Selling outpaced buying by a multiple of 2.3. How interesting. And we do have a chart on this. Let me see if I can enlarge this chart. Oh, yeah, there we go. All right. Download. I will just do this and share the screen with you. Look at that chart. Companies bought, companies sold. You've got the S&P 500 is the blue line, and the companies bought divided by companies sold ratio is the red line. And given that it's sitting at somewhere right around 0.4, gives you there it is, last 40 days, 0.42. 184 companies bought, 436 sold. Kind of interesting. Kind of see what the execs are up to. All right, cool. Hopping back over here for a moment.
People know that the stock was up 2% yesterday. But look, there's always people who want to call top in the semis. And AMD, NVIDIA, and Marvell Tech have been ones that are down a great deal versus Qualcomm. My chapter just knows all these because we really believe. Qualcomm, which was barely, Qualcomm's held up really well here.
Right.
But that's 5G.
But it does sound like you would avoid a basket of, say, Logitech, Best Buy, HP.
You know, what a great question, because Logitech did say that they saw a bottom in gaming hardware. You know what? I have to tell you, I think that Best Buy, that dividend is safe. They did think that the gaming cycle wasn't going to end until next year. They were wrong on that. 4.72% with very good management of the supply chain by Corey Barry. I would buy Best Buy.
All right.
Ooh.
Moving to some.
HP.
Yep. Moving to some.
One of the things I was reading the Best Buy earnings call. One of the things that thought is really kind of smart that Best Buy is doing. I just think it's branded poorly. Is they have this thing called like Total Tech, and basically you basically get, if you buy stuff with them and you're a Total Tech member, you get their Geek Squad support and assembly and all this kind of, extra help. Why I think that's interesting is I think there are a lot of people who, want to buy stuff like a new computer or, I don't know, electric scooter or whatever, but they don't want to put it together or they don't know how to, or they're afraid of what if it needs help? Who do I call? And nobody wants to sit on the phone all the time. So I think that the Geek Squad is probably a good move for Best Buy to try to encourage people to buy more stuff at Best Buy. Maybe browse online, but buy it at Best Buy to get the membership. So it'll be interesting to see how, especially since they include Apple Care too, it'll be interesting to see how other companies compete, especially Amazon. I know they try to sell insurances, but they haven't gotten to this like total insurance thing yet. Although I wouldn't be surprised if Best Buy actually finds that profitable, that Amazon ends up coming out with something like that too.
Yep.
Oh my, I felt like at the end, I wanted to don a green apron. Orange, by the way, in Mexico.
Orange is Home Depot.
No, in Mexico.
In Mexico? Orange,
yeah,
orange.
I was like, where's the green apron?
All right, we don't have much to talk about, so let's give a listen over to Bloomberg.
And you get the middle, and as he pointed out, it's over 4%, and it is not showing any signs of rolling over. So their job is not done. And he went on to say, as have others, that no, we're not at neutral yet. And on an effective basis, we're right below it. But they think they're going to have to go above that to bring down inflation. In fact, Bullard thinks we may need to go as high as 4% to get it down. So the Fed's work is not done, and they're trying to make that clear to people. Wishful thinking on the part of Wall Street isn't going to make the Fed react.
We had a lot of wishful thinking over the last week. Mike McKee, thank you. Looking forward to it.
Oops.
It's going to drop by again in about 30 minutes' time to go through some PMI data. Then the ISM services number comes out in about 53 minutes or so. Yields are higher again by 5 basis points on a 2-year. At about 3.1%. Yesterday, higher by 18 basis points. What was interesting about yesterday to me, if I told you up front, today we'll have an 18 basis point move on a 2-year, and the Nasdaq would fall by just 0.16%. I wonder how many of you would believe that. Michael Purvis, that raises a big question. What do you make of how the bond market's taken this down, one, and two, how the equity market hasn't really responded to it?
Look, on the bond market,
we're going to move off this guy. Let's jump on over.
Unleashing that move higher in yields was this person right here.
No.
Unleashing that move higher.
It's not letting me move.
Yields.
I want to go back to this Marie Daly. I want to see her talk, but it's not letting me do that right now. See, oftentimes I can go run back. Let me try it. Let's see if this works. Fancy.
Live from New York City, we begin with the big issue. Fed officials pushing back.
They essentially just reiterated the message they've been trying to send.
The pivot that everybody's talking about.
It's just too early.
Core, headline, CPI, PCE, whatever. It's all some huge number.
The Fed is actively trying to be hawkish.
Powell really endorsed this message of data dependence.
Seemingly quite a dovish tone and rhetoric.
I don't necessarily think they were that dovish.
Now we're actually having Fed speakers come out, be quite hawkish.
Evans coming out and others saying, no. We're still really focused on inflation.
I think it really did catch markets somewhat off guard.
We're going to have this fast and furious data rush.
To come out and explicitly signal something new.
It's too early.
The market is looking for a pivot.
We don't see it.
This was not a pivot from the Fed.
Joining us now, Tallbacken's Michael Purvis.
Oh my gosh. That was actually like an amazing compilation of all of these people commenting on, no, things are going to get worse. I need my puts to print more. I like that. That's hilarious. Okay, let's take a quick peek at the markets just to see how things are moving in the pre-market. And that is right here. Looks like we've got so things are still relatively stable here. We've got about 20 minutes to go before the market opens up. Doesn't look like things have really moved much. Enphase recovering after the Solar Edge drop there. Enphase might go over $300 here at all-time new highs right now. Great company. We've got PayPal, SoFi holding on to that 12 to 13%, Affirm up 4%, back to $29. And this comes after PayPal announcing that they're doing the pay over multiple months membership as well, which was originally one of Affirm's big moats. All right, hopping back over here. Let's listen in.
The trade down is not real trade down. The trade down is from supermarket to Costco. Now, if you think Costco is trade down, I think that you've just discovered an experience that you should have used a long time ago. Costco's numbers are very, very good, very strong.
I did like what Chesky told you, and that is when you go to a traditional hotel website, you know what you want.
Wasn't that great?
In Airbnb, I think he said they're in the inspiration business because they're offering you ideas of what your vacation may look like.
One of the things, my daughter was going to set up a treehouse hotel. Okay. And they have, do you want to go into a treehouse hotel? Well, they have the vertical treehouse hotel. That, I think, is exciting. There are some tremendous treehouse hotels in Oregon and Northern California. And, so that's what you get that. I mean, instead of thinking, I want to go to a hotel in Northern California, you say, you know what? I want to go to Northern California. Where would I like to stay? You go there, and it's like treehouse. You say, I've discovered something new.
Yes.
Now, people may be laughing at me. And I don't blame you one bit because I think treehouse hotels are pretty ridiculous. But I do know that he mentioned it as being something. Well, treehouse hotels.
Yeah.
There are some luxury treehouse hotels. 4-star.
I have no doubt.
They're, right. I mean, I don't know. How many stars does the bear get? Questionable.
Right. Well, we'll watch all those earnings, and there's a lot more to get to later on this morning as well. As for the broader market, so we did have St. Louis Fed President Bullard on Squawk today. He did talk about recession fears. Take a listen.
With all the job growth in the first half of the year, it's hard to say that there was a recession. With a flat unemployment rate at 3.6%, it's hard to say there's a recession. The second quarter, I think, was more concerning. And so I'll watch that carefully. But now what I think is going to happen in the second half of the year is that we'll get positive GDP growth in the second half. I think we'll have a reasonably good third quarter here.
Coming out of the Powell presser last week, Jim, a lot of people said, just wait. The Fed speak's going to run hawkish. And whether it's Mester, Daly, Kashkari, Bullard, that's what we get.
Well, I think it's smart to run hawkish. Why should you pretend that it's peaked? You probably have to do another 50. That's what I think the 2-year says.
Citi says 75 still today.
I don't think they're going to use 75 because I think by that point, it's what I'm talking about is going to be obvious to everybody. They will have gluts throughout the system. I mean, right now we have gluts. Go back to Walmart. We have gluts in everything at the retail level. We will have now that the semiconductors are no longer needed in Europe because the supply of the number of cars being made in Europe is dropping dramatically. So those semiconductors are fungible. They will come here. We know that if you decide to not export gasoline or crude, our gasoline can come down even with crude not going down. So food, the largest part of food is packaging. Every part of the packaging of food is coming down. It is only a matter of time before one or two of these companies.
And we're going to pull off Jimbo here. Let's briefly talk about what a lot of folks are talking about, this stock that some people say is bigger than the GameStop movement here. And this is this Chinese fintech, AMTD, which is an ADR, which means it's an American Depository Receipt, which is basically just a fancy way of saying that this is not an American company; it's a Chinese company, and you're trading like a small interest in the company that's sort of sliced away for to get exposure to the American markets. Now, these usually have incredibly low liquidity. There are usually very, very few shares outstanding. So it frequently doesn't take much for to move stocks like this. Although right now, based on this crazy run that this thing has had at $9 now, it has technically an over $2 billion market cap, which seems ridiculous for a company that had like $25 million of rev. But let's it IPO'd with like a $244 million market cap, right? It's nearly 10x. So this is going to be interesting. I think we all kind of know what happens when there's insane momentum. One of the problems is these stocks can become extremely hard, because some people are like, okay, well, so if it's going to go down, does that mean short it? One of the problems that you have is these stocks become extremely difficult to borrow against, so it becomes very difficult to short. And the volatility is so high that the puts are usually insanely expensive or not even available. In this case, at least via Webull, options are not even available. So, yeah, that's AMTD Idea Group. And it would be interesting to see some of their financials. So let's see if we can do exactly that. We'll go to the SEC and look up some filings. Of course, the ADRs, usually it's a little tougher to read their filings because they're not at all what we're used to. TD. Usually when I go through NEO, it's like, okay, yeah, this is going to take a little bit longer. But that's all right. So if we take an annual report, annual foreign report, which we have from them, we can get some insight here. So let's do a quick look. This is the company, and I want to see financial statements. So I'm going to jump right down. Where are they? To the financials. All right. So here we go. These are all in Hong Kong dollars, so we'll have to do a little bit of dividing here. This is their balance sheet, which shows assets of about $3.8 billion of Hong Kong dollars. Let's see here. AMTD. Okay. This is, if I go 86 billion to USD, there we go. Let's get a little conversion going. That works out to about $10 million. Wow, really? Or hold on, are these in millions or thousands? No, these are just the way they are. Wait, no, it's only 86 million. Yeah, okay, well, yeah, that, okay, there we go. Yeah, okay, no, I did the math right. So it's 86 million to is about $11 million. Is okay, well, that's what we've got here in terms of accounts receivable, but I want the whole number, cash assets. So yeah, okay, 3.8 billion. Oh my gosh. 3.8. The numbers are so large. But I hate doing currency conversions. There we go. Okay. This suggests total assets of about 495. 495 million dollars. That's just current assets. This is interesting. This is a very interesting company. I don't know much about this. Let's see here. Statement of cash flows. Oh, I wish this was in dollars. Assets. Here's the balance sheet. Where is the income statement? Revenue. Okay, here we go. So, oh, wow. Profit for the year. Okay, here we go. So profit for the year, 830 million HKs to now 1.2 billion HKs. What does this company even do? I don't know. Anyway, a lot of folks have been asking about that one. So, there's also there's AMTD Idea Group, and then there's AMTD Digital. This is the other ticker symbol, which is ticker HKD. So you've got both of them. And this has had the same kind of movement. These are weird. I have no idea what's going on with these. HKD versus AMTD. Let's see. AMT Digital is traded under HKD. Huh. I don't know what the difference of these is. All right. Well, that's going to take a little bit more research. I'll dig around a little bit, but you've got, I would say, oh, here we go. AMTD owns 97.1% of the outstanding shares in HKD. Thank you. Thank you for that. Okay. So that explains why the other one is moving up. Got it. So HKD IPO here as a primary listing? That's possible. It's possible that AMTD is the ADR for the Chinese company and that HKD is the listing in the United States. That could be. Anyway, that's a thesis. It's something to get to the bottom of. But anyway, clearly you've got some incredible momentum movement here. I would just express a lot of caution. So I'm going to dig a little bit more and see what other news we have as well. Let's listen into Jimbo for a moment here.
David Calhoun waiting for that big Boeing order. I think you're going to keep waiting.
Yeah. Although I will add, B of A this morning said we got some food export suspensions to Taiwan on their part, obviously military drills, but they said the bite after that, not much.
No,
as she left.
It's just that I don't really care.
And remember, that was expected with Pelosi and Taiwan, that you would get this saber rattling, and then that's it. Because China has to try to prove to their constituents that, don't worry, we're strong, we're safe, keep obeying Chinese, communist principles, because we're better than the United States. We'll show them. And you do a little saber rattling, you do some military exercises, some planes buzz each other or whatever, and then everybody forgets about it. It's literally the same thing every time stuff like this happens. It's ridiculous.
Make him stronger. How the heck did we make him stronger? It's on us. Shame on us.
Yeah, I'm not sure that's I don't know. People are looking. Look at FT got a piece on Samsung rethinking their exposure to China because of the CHIPS Act.
That's true, but we were, got a big meeting coming up. Look, she is it's a Cold War opponent. He might as well be Stalin, okay? And we don't want Stalin strong. We want him weak.
Yeah. We'll see. A lot of cross currents, obviously, in the wake of her visit as she's now left. When we come back, we'll get Kramer's Mad Dash. We'll count down to the opening bell. Still got to get to PayPal, Match, Regeneron, Gilead, SoFi, CVS, and Hood. Futures are green. We're back in a moment.
Yeah, futures definitely are green. And I really think a lot of this is based on the idea that we are not faced with any kind of massive fallout from the drama of like in China and Taiwan. I think there was quite a bit of a period of time where a lot of people feared that what you could actually see happen is war with China and like some kind of World War III. I mean, that was trending for a while. This idea that, okay, well, if Russia can invade Ukraine and the U.S. said we would defend Ukraine or at least help them, then what happens if China invades Taiwan? Does that now pull the United States into battle with China? Or does, because the United States didn't maybe help Ukraine as much as expected, does that set up this precedent for, the U.S. is getting weak, now's the time for China to strike? I don't personally believe so. There were some comments that I thought was interesting. Someone mentioned that, hey, well, you got to be careful, China, they could just yoink all of our cut off trade with the United States in some kind of battle. And what I thought was interesting here was we have, while we do have a deficit with them, we exchange the biggest item that we exchange and trade between each other is electronic machinery. And we take in about $130 billion a year of this sort of machinery. They take in about, I think it's a little bit more, like $180 billion a year of electronic machinery from us. So that would be devastating to manufacturing, certainly on both sides, as people look for replacements. But the biggest reason for our deficits that we have, in my opinion, is the other items in the trade between China. And that's literally the following: toys and furniture, which, I don't know. I mean, I value kids having Chinese toys, but there are alternatives. So I don't ever see that happening anyway. But I think it was very interesting when we break down that trade deficit. The damage, I feel like, would be equally great to both countries from a machinery perspective. All right. Let's see here. Let's take a look at who has earnings today. So today we have Moderna reporting before the open, CVS and Regeneron, Yum Brands. Oh, EXPI reported. And then after the bell, Lucid, Marathon, eBay, Fastly, Skills, MGM, Clorox, Booking. Wow. We've got 5 minutes to go before the... I'm going to do a quick pop open here, and let's see if we can do a little bit of exploring and see how some of these tickers did. In fact, $2 here. EXPI released earnings. Let me pull up EXPI and see how they did. So EXPI is the real estate firm. They're basically a commission-free brokerage. EXPI World Holdings earnings fall as revenue gains, hikes quarterly dividend by 13%. Hold on a sec. Taiwan's release is this happening? Oh no, okay. There we go. Yeah. Taiwan Defense Ministry, 22 Chinese aircraft cross Taiwan Strait median line. Yeah, see, that's exactly the kind of junk that you're going to see more of, is you're going to get more and more of those headlines of, oh, we had some planes cross lines or whatever. It doesn't matter. Okay, so EXPI missed. They had earnings per share of only 6 cents, and the estimate was 19 cents. And this is as their revenue grows to $1.4 billion. So one of the downsides that I found with EXPI is that their ability to actually have a larger profit margin is low. They don't have much of an opportunity to push for margin because there was zero commission brokerage. Now they try to take somewhere around $15,000 up to about, I think it's $15,000 per agent, which I think is great for agents. In fact, at one point we signed up. I think we have an EXPI link as well, although I never really mentioned it. I think if you go to metkevin.com/EXPI or EXP, it might be EXP. You can sign up to be an agent there. But because they pay out so much of the revenue that they get in commissions from other agents, and sort of kind of almost like a little bit of an MLM style, even though it is a legitimate brokerage, there's not much money left for them. And so seeing the EPS fall, it'd be worth looking into their earnings a little bit deeper to see, is this just a sign that, yeah, I mean, they can grow, but they can't grow their net income? Or is that, or is there some specific reason for that? One of the things that I would look into if I was investing in EXPI, it's only moving down about 4.8% after that EPS miss. Let's look. CVS is interesting because they do tell us a little bit more often about the consumer, especially if we can get some headlines from them about the consumer. So CVS, liquidity cash position remains excellent. Reports lower Q2 adjusted earnings, but revenue climbs, and they're lifting their forecast on a strong quarter on insurance demand and COVID tests. Let's see what else we can learn. 2 minutes to go until the bell. CVS reports fiscal year revenue of a lifted guidance with a midpoint of about $309.5 billion of expected revenue. The forecast was for about 307.5, so a little bit of a push there. CVS posts another beat and raises guidance. Sales rose 11% in the second quarter. It's incredible. I always found CVS somewhat expensive, in my opinion. Like when you go there to buy whatever, it's up about to what, 2%, 2 to 3% in the pre-market here. All right, we got a minute to go before the bell. Let's listen in over here and see what we got.
Also, PayPal, the cadence was good. Each month got better, which makes me feel that at last this overhang from eBay is done. So very good quarter, upgraded by a lot of people. A lot of people have given up on PayPal, and they did well.
Yeah, $15 billion buyback doesn't hurt. Truist today goes from 80 to 108. We haven't seen that kind of action in a while.
No, and price target raised by Morgan Stanley, Evercore, Wells Fargo raises it. And I just think that when you look at what he's done, Credit Suisse, it's rather amazing that he pulled himself out of this tailspin. Because they also named a fellow by the name of Blake Jorgensen from Electronic Arts to be CFO. Remember, they lost their CFO, Rainey, to,
Try to move. Let's see if it holds here as we get the opening bell and the CNBC real-time exchange of the big board, the Professional Fighters League, ahead of Friday's playoff. And at the NASDAQ, NYC and Company's the official destination marketing convention and visitors bureau in New York City 5 boroughs.
Oh, wow, that's green.
It's been nice to see tourism rebound in this city.
Yes,
That is quite green on that initial chart there, although QQQ, based on the sticks here, having a hard time actually staying green. Looks like you've got a lot of pressure coming in on both sides. Let's see how these things move. Occidental Petroleum down about 1%. Tesla sitting at about up 1%. Uber up 1% after its run yesterday. Enphase dropping about 3% here right at the open. I think it's so overvalued right now. Solar Edge also dropping. It looks like you've got some institutional selling pressure coming in on these solar related stocks. 13% now down on Solar Edge. You're down 14% now on Solar Edge. You've got a little bit of a plummet here coming in with institutional selling. It looks like QQQ going green. There it is. Broader market going green. Really shows it's getting tough to pick individual stocks and time them perfectly. It's very, very difficult in this market. But look at this. SoFi ripping, folks, up 15, almost 16% here. A rip on SoFi. Very, very nice. You've got PayPal sticking around that 12 to 13% range. You've got Affirm moving up 5%, following in PayPal's footsteps. Looking down towards the negative side. Big loser right now. Solar Edge down 17%. Enphase down 4%. AMD down 5%. Airbnb holding around that 6% down. EXPI only about 2% down, even with their EPS miss. QQQ, watching QQQ. I think today's a big test of a day. Is will we be able to get above 318? That's the big goal today, is get above 318. We're sitting at 317 right now, up about 0.85%. See how that goes. Enphase recovering a little bit right now, only down about 2.8%. Tesla up 2%, 2.2%, sitting at 921. Tesla properly above its prior support level, sitting at about 880, being a larger support level for Tesla. Tesla now decently above that, retracing back to higher levels. Enphase still bobbing around 3%. Solar Edge is really the one that's having the sell-off here. I mean, really remarkable sell-off here, down about 19% right now. Larger institutional selling is my guess over here. I don't know that retail is going to have much of a move here, but it's possible. I know a lot of funds like Solar Edge, and we've seen some insane volatility on this stock. I mean, again, we were at $200 in January and May, and just before the bell, we were close to 375. Now, well, like 350-ish, somewhere on there. And now we're sitting at down 65 points at 300. Wow. All right. Let's take a listen over here, see what Jimbo's saying as we open, and I also want to take a look in to see what the suits are saying this morning.
Regeneron got the other half of this Keytruda drug very cheap, of their libtiode combination. This is very good and must be watched, because a lot of people have said, well, you know what, Len, he had his thing, and Dupixent was not as good as it. No, I think that if he has something that really works for prostate cancer, it's
all right. They're talking about pharma. I don't know much about pharma, so I'm going to pull off that. It does also look like we're seeing yields rise more. 10-year still sitting at now 2.77. I do want to look at what this means for our break evens, because remember, our break evens or our future expectation of inflation. 5-year break even right now sitting at 2.76. That's slightly higher than the low we got to of 2.58. So the market pricing a little bit of a harder move to get inflation down, but still substantially lower on the 5-year break evens. We are as low right now as we were in December of 2021 and October of 2021 in terms of inflation expectations. All right. popping back over here. And if Jimbo's boring, we'll go over to Bloomberg.
Open. People are going out again.
Revenue miss, revenue per user miss.
Some new new division head.
They guide below. Yep, they guide below, and they do.
All right.
And Stanley has been ringing that bell for some time. He says the magnitude of cuts are just too modest so far, and he expects things are going to get worse as the economy deteriorates. He thinks the bulk of the cuts will be coming in the fourth quarter of this year. And just today, RBC Lori Halvacina joining him in that, saying in the second half, we could see more cuts coming.
This is the worry hanging over the market. And Kelly, thank you. Is that
that is a big deal right now is, hey, how much are we going to get in terms of EPS cuts, right? Big deal.
Worried about the future. This is what RBC's got to say. Kelly mentioned Lori Calvacina. The rally in stocks is fragile, given the possibility of further downward revisions to earnings as 23 comes into view. Well, the downward shift is what investors had been hoping for. The magnitude of the declines doesn't match up in our minds with the idea that a recession is starting or is on the horizon. Laurie, I'm pleased to say, joins us right now. Laurie, your language, we just haven't ripped off the Band-Aid, have we?
We haven't. And, it's funny, John, I spent a lot of time on the road coming into this reporting season, and that's what I heard meeting after meeting. We've got to rip off the Band-Aid. We want one big cut. We don't want to drag this out. That's what investors wanted to see. And we're looking at 2022 forecasts for the full year that have come down $1. We've looked at next year's numbers that have come down by a couple bucks. And so we're left here in a position saying, okay, either the Band-Aid doesn't need to be ripped off or it's still got to be ripped off later this year. I'm inclined to think that perhaps, I'm not quite as bearish as Mike, but I do think that we do need to see a bit more downside. We've modeled out what we think the current macro is forecasting for this year and next. We come up with 214 for this year, 212 for next year. So even if we're too conservative, we still think there's some more froth that needs to come out. And even if we did see the lows in June, it's possible we could go back down and retest them, or we could simply stay volatile until we get this issue resolved. But I just find it very, very interesting that the market has rallied so strongly when investors are getting exactly the opposite of what they said they wanted.
Hey, Laurie, it's doing it again. The Nasdaq's at 1%.
I don't actually think we are getting the opposite of what we wanted. I think we're getting exactly what we wanted, which is the Fed going, okay, we're close to completing our job, and then just pausing,
Today, yields are higher again by 5 basis points at the front end, back to 3.1%. The Nasdaq's up by more than 1%. What are you learning about this price?
Ooh, that means if the Nasdaq's up over 1%, that means we might be over 380.
I will say that when I dig down into the tech and growth-oriented sectors in particular, I feel perhaps a little bit better. So we look at tech in particular. It's fueling some of these really, really strong beat rates that we're seeing, at least on my work, which was through Friday. It was the best sector on earnings beats. So I think perhaps just some confidence being instilled by the fact that the quarter was so strong. But I will say, John, when we look at the rate of upward revisions in technology, even if the numbers haven't been cut enough in dollar terms, what we are seeing is that basically nobody has been taking numbers up. So the rate of upward revisions is about as low as it tends to get. We're seeing that as well for things like communication services. Now, what that is, that's a gauge of earnings sentiment and how people feel. So perhaps in that tech complex in particular, just the sentiment got so lousy, it's allowing us to really just rally on what's already happened and the idea that a lot of pain is already understood to be coming. I feel like I'm stretching a little bit there, but that is what I think may be sort of fueling this, kind of move in tech. And we do like the valuations in tech. So, I'll take this as a win and not be too greedy.
Laurie, I know you follow the earnings calls as well. Bank of America does too. I'll share with you what I learned from Bank of America, and then you share with us what you're learning from the work you're doing. I read this quote yesterday in their report. It said the consumer's being squeezed by inflation. 40% of Americans are reportedly having difficulty paying their expenses, above the 38% peak during COVID, according to a census survey. Then they monitor the calls, the earnings calls. Mentions of weak demand spiked to the highest level since COVID, with record weakness in consumer discretionary demand. So I'm reading through that. So I go to the chart of S&P 500 consumer discretionary. We're up almost 24% from the June lows. Laurie, what do you make of that rally in consumer discretionary? That is a monster rally from the June low.
Look, I think if you go back and look at that June 16th low for the consumer discretionary sector, it was the decline that we had seen in that sector since the early January market highs was pretty much in line with the average recession drawdown that you do typically see in the consumer discretionary sector. Now, that sector's changed composition a little bit over time. There's more internet stuff in there now than there used to be. But I think a fair argument could have been made that we saw recession essentially baked in at that June 18th low from the perspective of the price performance itself. I do know that when we look through some of the industry revision indicators, things like specialty retail, internet retail, we're similar to what I was just describing for tech before. We are seeing sort of record low type rates of upward revisions there. So perhaps just the sentiment got so bad in that particular space, it allowed that rebound. And
yeah, I'm going to pull off here. It is really fascinating at just how many of the institutional managers are like, oh, yeah, the bounce makes sense, but more pain is to come. To me, it kind of is almost a way of like some of these people kind of almost admitting that like, yeah, we had too much cash, we effed up. Sorry, investors, we done effed up. We were too little exposed and we didn't buy the dip enough, right? We had too much fear. QQQ right now sitting at 318, folks. This is my magic number. This is where I want to see QQQ. If we can hold 318 today, if honestly, I think the big tell is if we can hold 318 through August 10th, oh man, that's gonna that's gonna be good. Because remember, August 10th, CPI comes out at 5:30 a.m. So, that's an early release for data. You've got all day to go through. If we can hold 318, whether that means we go to 325 and maybe fall a little bit or whatever, it should be bullish. And I think that's what we're seeing right now. We're seeing Tesla up 2.4%. We're seeing Enphase. I've been expecting this to come down. I got stopped out of my short yesterday. It wasn't a big short. It's just and I knew it. It's like this can't last. I honestly won't be surprised to see Enphase at this point pull back down to something like 220. If we could get it under 200, it'd be substantially nicer. But I'm patient here because I really think that come the end of the year, you're going to see a slowdown from households in being willing to spend money because you're going to get this element of, oh God, we're in a recession. People are starting to dump their homes more now than they have been. I'm hearing people literally selling their homes solely because they're worried that the market is going to fall. And these are like homeowners. And it's like, well, where are you going to go? Oh, we're going to rent. Or, oh, we're going to move in with family. Like you're starting to see that kind of like slight pre-panic come in. It's just quite interesting. Tesla 221, a little volatile in action here. Went all the way. 921 went all the way up to about 928. Nasdaq, first little red candlestick coming in on the average candlesticks here. Solar Edge trying to bounce off a bottom of 295, down about 17% right now. Occidental Petroleum dropped as well. Remember, we've seen the dollar or gas prices drop towards an average of $4. I think the dollar's been dropping something like, I don't know, 40 or 50 days in a row now or something like that. It's not the dollar, the gas prices. It's been dropping quite a while. Let's see how the dollar is doing, actually. I'm going to look at the inverse. This is a little bit of a mess. Let me look at, if I could just do no, not USD. What is U up? U up. There we go. This is the dollar. There we go. Dollar actually moving up slightly today. You've kind of had an interesting move on the dollar here. Here's the chart of the dollar. This is when the dollar was at peak, was about July 14th. It's kind of been trending down since then. A lot of volume came into the dollar yesterday, or at least U up. But then again, this, it trades with some decent volume, 2 to 5 million, and went all the way up to a 15 mil volume. This is an ETF, so the volume here isn't necessarily indicative of what's actually happening with volume on the dollar. Okay, let's take a listen to see what some of the other suits are saying, and I'll also get to that. Okay, literally everybody just went on commercial. Really? Let's see. Is that true? Bloomberg's on commercial. There, here we go. They're not on commercial.
UAE. I was looking into a report that was brought to my attention from someone who works in the industry, and our own government says by the year 2050. Oil and gas will remain the most used source of energy. We're still using it more than any other form of energy through the year 2050. We're going to use renewables too. So we're walking and chewing gum at the same time, but 4 times more oil.
3 decades from now,
so
still going to use it.
Take the right steps to make it more affordable and easier to get.
You're not talking to the right people. New studies do, however, reveal that the president's climate agenda could force fuel prices to rise. We have Jeff Locke in Pennsylvania. Any idea how much gas prices could go up, Jeff?
Oh, you're going to buy an electric F-150. Why do you care? You shouldn't even care about the price of gas.
But I do for
In
my
answer to
fellow
your
Americans who
question-
still have combustion engine cars.
Gotta love those combustion engine cars. I want to pull off this for a moment and just mention, here's an interesting piece. Bulls at risk of falling prey to bear market rally, charts show. The list of obstacles to the stock market rally get longer by the day. Equities had a blast in July with those earnings in Europe, and the US rising more since 2020, blah, blah, blah. Okay, so what do the actual charts show? Let's see here. Bear market rallies are no guarantee of a bottom or market turn. During the 3 years of the dot-com meltdown in the early 2000s, the NASDAQ 100 had 9 monthly rallies of more than 10% before falling a base. Interesting. So a little sort of word of caution there. Let's see if I can show that chart. Let's see. Yeah, it's actually a very interesting chart. In 1 second, we'll have that up. All right, here we go. So this is the chart they're showing here, and you could see this like 2.5 year bear market, and you see these pop-ups of monthly rallies, rally 9 times, right? In the midst of just the NASDAQ basically continuing to trend down. And you do get these feelings of like, oh, here's the potential bottom, right? Oh, maybe this is a bottom. Oh, maybe this is a bottom. We kind of kept hitting bottoms. Now, one difference between now and then is that you are seeing the stock market fall somewhere around 3 times faster, or we have seen it fall 3 times faster than the dot-com bubble. Let's see what else they have here. Then we'll head to the comments. Spreads cautious. Okay, these are bond spreads, earnings cuts. That's probably the biggest argument that that companies are probably going to face some significant earnings cuts. But the markets and the suits have been talking about that straight for the last, 3 months, and about how the market just isn't pricing in the earnings cuts and blah 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 blah. I don't know. Everybody keeps saying it, but so far, I mean, we certainly saw big tech do quite well, at least relative to expectations. I mean, Google slowed down. They're not growing like they used to grow, but they still did pretty well for what's supposed to be pretty painful. Tom Baker for $4.99 says Robinhood is up 4.65% today after it lays off 1/3 of its staff. Thoughts on earnings today? Yeah, so they're actually up 10% now. Wow. They released their earnings yesterday. They released their earnings early. And I actually think it's a good thing. I mean, the stock is like straight up today. But then again, so are a lot of stocks. Here's the concern with Robinhood is, first of all, them laying off staff is a good thing. They have a massive amount of customer service reps. And the reality is people are trading stocks less now than they used to. You don't need as many customer service people anymore. So my guess is a lot of the people who are getting laid off are probably in CS, not necessarily in, not to be confused with computer science, in engineering. So I'm going to guess customer service got hit hard. We do have their letter and their press release. I started going through it yesterday. I actually have that right here. So Robinhood they pre-released their second quarter results yesterday. So their results are already out. They saw average revenue per user go up. They still lost money. And, they're trying. I don't think they're a terrible platform, really. But, boy, they just had such a sentiment hit from the GameStop crisis. I mean, if we look at assets that they have, let's see here. Free and clear assets. Let's try to draw on this together here. It's a little tough to read. Total current assets, 19 bill. Total current liabilities is a little difficult to actually see here. Let's draw a line. Total current liabilities. There we go. Total current liabilities, sitting at about 12.3. So even if we just clear that, although we do have receivables, but then we have payables to users, receivables from users, still got 6.2 billion bucks in cash plus about got about $10 billion in cash right here. Some of this is going to be payables to users, but then again, that roughly washes with your receivables from users. Securities loaned, they're showing as liabilities. Okay, so free cash. Try to figure out exactly what we want to do with securities loaned here. So securities loaned being a liability, that means that, let's see here, security, because they started doing stock lending. I just want to see if they have anything up in the asset section about this. I'm going to have to read into their annual report a little bit more for this. But just doing a quick glance at this, what's Robinhood's market cap right now? This is... now they're sitting about $8.2 billion, and they've got roughly that in cash, right? So they're still roughly trading for that cash value. Even if we take out the securities loaned, we're sitting at like $6.5 billion in cash and cash equivalents, free of payables and receivables. You're still getting cash value here for the company. The reason the company's selling so close to cash value is because they keep losing money, right? The good news is that it looks like they lost a little less money this first quarter or this second quarter than last second quarter. They lost 295 versus 502. Transaction-based revenues, though, plummeted. Look at that, a decline of 55%. This is why they have to lay off people. However, they're also spending more money on technology and development. Remember, they started doing crypto wallets and that. So they spent 56% more on tech and development. Look at their marketing budget, though. Their marketing budget absolutely slashed, 74% decline in the marketing budget. And their staff expenses have doubled. So you could see, I mean, it's actually smart. If they want to have any chance of going profitable, cut staff, cut marketing, which they've already done. And yeah, you've got a company that's trying to right itself. And the market seems to be rewarding them for that today. Again, looking at the chart today, we're getting our first average red candlestick right now after it rose 11% here. You've got Tesla sitting at 918, really struggling to stay above the 920s there. Enphase back to 280, finally having a red day. You have... Oh, wow. Seriously, Tupperware up 56%. Did they report or something today? SoFi now 22%. What a rally. Holy moly. This is dragging up a firm upstart. All of the brokerage and lending plays, your more risk on fintech plays moving together here. Maybe sort of like a fintech basket moving up together. Still personally attracted to Hut 8 calls in the event that Bitcoin does continue its rally. Even Etsy up a couple percent today. Solar Edge, really the pain play at down 17%. Where did Airbnb go? Oh, Airbnb's recovering. Airbnb was down about 6%. Look at that nice recovery, now only down about 3%. All right, what's this update coming through? U.S. senior administration officials. U.S. That wants to see more on home energy supply. OPEC plus oil output decision is a step forward. Blah, blah, blah. PMIs. S&P Global July final services PMI comes in at 47.3. Slight beat compared to the 47 expected, along with the composite 47.7 versus the 47.5 expected. Let's see what info we're going to be getting at 7, if anything, this morning. 7 o'clock is usually a release time. Let's go ahead and listen over here in the meantime.
Earnings recession so far. We have seen key stocks like Amazon and consumer discretionary, Meta and communication services. Their numbers have been coming down for the whole year. They've dropped their sectors, but overall, no earnings recession. As far as the health of the consumer, we talked a lot about Starbucks, Howard Schultz saying no reduction in consumer spending that we've been seeing. Yes, and you can see this has been echoed by some other people. Chipotle a couple of weeks ago had a very similar comment here. Put that up here. This is Chipotle executives. The majority of our customers are a higher household income consumer, and we've seen their frequency increase and potentially not experience some trade down. But to the extent Starbucks and Chipotle are higher end consumers, that's certainly true. McDonald's was not so sanguine about this. A couple of weeks ago, on July 25th, Kevin Ozan said, we are seeing some trade down. We're seeing customers, specifically lower income customers, trade down to value offerings and fewer combo meals. So the obvious takeaway, and we saw this with Simon Property Group, is higher end still holding up, lower end's not. But this is really a complicated environment. I just want to put up the CEO, David Gibbs, what he had to say here today. I would say the U.S. demand is generally strong, but this is a very complex environment. And he went on to describe that it isn't quite as simple as just saying the high-end consumer is still holding up in the low end, that COVID, supply chains, China has really made this a very, very difficult environment. He said it was the most complex environment he's ever seen. So, Carl, I think it's certainly useful for all of us to say high-end's holding up better than the lower end. But there is an awful lot of really complex parts to this. And that's why the outcome is still so very difficult to predict. Carl, back to you.
Remarkable comments from Gibbs there, Bob. You're right. Thanks, Papasani. Jim, what's tonight?
Okay, one of the best performing companies during the duration has been Thermo Fisher, TMO. Mark Casper, the stock's been just on a tear since he was, since they reported, and I think that's right because they know what to do post-COVID. And then the now controversial Lisa Su, well, the stock was down 6, as there were people who I would normally call morons, but have become much more of a statement than 15 years ago. Ill-advised people sold it down 6 points. I think ultimately the stock should be up because it was a great quarter. But you know what? They know nothing. I'm sorry if I offended anyone by just describing what happened to me after, but my wife says, why did you ever say it? You should never have said it. I said, because it was the truth. And she said, so what? Look what it did to you. And I said, I'm proud of it. She goes, you have nothing to be proud of.
Yeah, that's one reason we turn to you, Jim, is because you don't pull the punch even though you know
she said, look, you took tremendous heat. What was the point? I said, the point was to help people because that's what I try to do because my boss is the audience.
Jim, we'll see you tonight. Thanks. Mad Money, 6 p.m. Eastern time. When we come back, we'll talk with.
All right, so let's answer a question over here. We got a question here from Tom Sell. How do you feel about the Buffett indicator showing the market as a whole are potentially historically overvalued by 50%? So I got this chart here just to sort of show you what Tom is talking about. This is the Buffett indicator, and really what you're doing here is you're dividing the market cap of the entire market. So let's say the S&P 500 sitting at around, let's say $32 trillion right now, maybe a little bit more, and dividing that by GDP. So the more market caps rise at the same time as you're seeing GDP kind of stagnate because potentially we're in a recession, the higher this line goes. And you can see how extremely overvalued it had gotten, almost 2 standard deviations away from maybe that fair value of more of like a 1-to-1 ratio. And so that's kind of what the chart here shows. One of the things that I always found interesting about the Buffett indicator is a lot of this market value that we get is driven by expectations that these companies that are driving growth today are going to be able to have so much more revenue in the future than they do today. And that's driven by what we've seen with tech stocks over the last 10 years, really, these explosions. I mean, 10 years ago, what was Apple's revenue 10 years ago? Let's see, Apple revenue 2010, for example, right? They had $65 billion of revenue. Apple revenue 2021 is 378, right? So like 5x. I mean, that's such a substantial amount more of revenue. And so obviously, you have nearly $400 billion of revenue. That's going to lead to a substantial velocity of money that boosts GDP a lot more than what we would have seen 10 years ago. And so I think you've got a stock market that to some degree is predicting that tech companies are going to be able to create so much more GDP in the future that you actually have a little bit of this escape from this historical, oh, yeah, we're always going to trade right along with the Buffett indicator because now today we have companies that are likely to produce more revenue than any company in the past has ever been able to. Because like a SaaS company, for example, can generate money where people never thought to spend money. I mean, now, if everybody signs up for $10 a month of, let's say, Norton, VPN services, just as an example, well, that market didn't exist 20 years ago. And so now I feel like the market starts realizing, oh, wow, okay, this is the total addressable market. Everybody can have this. This company can easily grow into this or whatever, VPNs as total sector. Let's price that into the market now before it even gets realized in GDP. So I think in the long and short of my sort of reaction to this is I think there could be this potential that because today we have more technology companies that likely are creating new markets that we haven't had before, I wouldn't be surprised if we tend to trend higher above this historical trend line. I don't know if that means it's a full 1 standard deviation above or if it's 20% above, but I don't know if we're going to see that 0% line again. It's possible. I mean, I think that would be a wonderful opportunity. One of the reasons you could see that maybe happen is if you start seeing the market caps of legacy companies go down substantially, right? So if let's say GM and Ford go bankrupt, right? Because they just can't transition to EVs or Volkswagen or whatever. And you start seeing these companies get deleted. Not that you would. I don't actually think that you will. But I'm just saying as an example, if that's not offset by a gain in market cap of other companies, hey, maybe you see that compression back to maybe that more fairly valued line. But I don't know. I don't believe that. First of all, I don't think those companies are going to go bankrupt. I want to be clear about that. But I do think that the markets are somewhat different than what they were in the 90s and 2000s. So I don't know how useful this will be going forward, but we'll see. It's something to pay attention to. And if anything, it gives you an idea that, boy, oh boy, look at the move that we've had from where we were to where we are now. That's pretty neat. All right, let's take another peek at the stickies. Hopping over here. All right, so what do we got here? Solar Edge still sitting down about 17.3%. Enphase down 3.4. Airbnb looks like it's probably going off on its own little rally over here. NIO is stuck under 20. Yeah, Airbnb, people are buying the dip on Airbnb. It's up. It's now only down 1.6%. It was down a lot more before that. And big rally here on Tupperware, 54%, SoFi 22%, PayPal 13.5%, moving up. Look at Coinbase move 10% on Coinbase. Upstart up 12% now. You've got what else do you have here? Uber up 5% again after an incredible rally yesterday. Matterport up 4.7% right now. Nice moves. We've got, how's QQQ doing? Are we over 318 yet? Yeah, we're almost at 319. Wow, look at that reject on the Fibonacci here. These are roughly this 318 line right here. This is our famous triple dip from Feb, March, April support, which we broke through, and now we're back to. And then we've got our 38.2 fib over here. This is, I mean, the market's in rally mode. It's hard not to get tempted to try to chase some of the rallies. Look at that. Tesla lagging behind, though, not keeping pace. Tesla only up 1.6%. One of the things to keep in mind, though, is the more everything else gets expensive, the more people start looking around again going, oh, like where can I get another deal, or where can I get another opportunity? And that helps rise tides, right? Or what do they say? Rising tides lift all ships. Okay, so the 7 o'clock data came out. We had a survey of factory orders coming in at 1.2% growth. They actually came in at 2% with an upward revision. So that's actually good news. Durable orders were expected to come in at 1.9%, came in at 2%, also a beat. We have the ISM Services Index was expected to come in at 53.5, came in at 56.7, also a beat. So multiple beats here. Mortgage applications up 1.2%. We did have a little bit of a dippy duty in interest rates last week, so that's probably why we're seeing a little bit of a tick up, but still nominal. We're still trending substantially down. In fact, I wonder if I could pull up a chart of mortgage applications. While I try to do that, let's take a listen in over here and see what they're saying.
We show that when GDP has been negative for 6 months, payrolls on average fall about 0.5 percentage point per quarter. These past 6 months, payrolls are up a full percentage point. So instead of losing 1.5 million jobs, we've gained 3 million. That's a 4.5 million job swing. Dallas Fed also out with a similar conclusion yesterday, showing job growth behavior these past 6 months is just much stronger than the average recession. And that's true for almost every other monthly metric they look like, except for the quarterly GDP data. So how long can this job strength last? A lot of hiring has been putting people back to work from the pandemic. That process could be ending. Several big companies have announced layoffs or hiring freezes, yet by many accounts, workers remain scarce. So those laid off could find jobs pretty quickly. And if we don't have a big decline in jobs, it's unclear, guys, if we've had a recession at all.
Yeah, Steve, it's clearly unprecedented times and hard for economists and market pontificators alike to know what the future holds if we don't know what the past looks like. Thank you so much for crunching that data for us and for bringing us that interview. While market bulls have pointed to June lows as a bottom, our next guest doesn't think so. He's forecasting more volatility ahead as we get into September. So let's bring in Evercore ISI's Julian Emanuel. Julian, so you don't believe that June 17th low on the S&P of 3636 is indeed the low for the year. Rough Q3, maybe some rebounding in Q4?
Very consistent seasonal type patterns. And again, you know, we were heavily endorsing the rally back in June and July, but as is extremely typical and stranger to a bear market rally, you actually see uncertainty increasing. At the same time, FOMO has set in, whereas back in June, there was lots of fear. Put it all together, and when you think about the data that we just saw at the top of the hour, it's very clear that the Fed is going to stay resolutely hawkish against the backdrop of, look, this is clearly not a recession by all conventional means, but it's very slow growth. And that's a difficult combination for stocks.
Where does this current complacency come from?
What is it with all the suits just trying to talk down the market? I swear, I think they missed out.
In the wall of worry. And you're right about the wall of worry out there. We've got geopolitical risks. We've got monetary tightening out there, rates increasing, potential softening in the labor market, you know, little evidence of that. 2 consecutive quarters of negative GDP, and the market kind of just shrugs it off and says, you know, whatever. Is that just kind of a end of July, August phenomenon? Do you think things will change in September?
So when you think about the evolution of 2022, 2 key things. First off, professional investors de-risked the minute they started getting concerned about Russia's invasion of Ukraine and inflation spiking. The public was a little slower to sell. The public did sell in April. But all of a sudden, if you go back to the June FOMC meeting, you had yields fall, and stocks have responded very positively to that. From where we stand right now, particularly given the data, again, that we've seen at the top of the hour, the fall in yield story has likely run its course. And that, too, is a headwind for stocks. But the options market is telling you that people just aren't really concerned about too much. And I think you could easily make the argument that some of the activity we've seen in the last several days shows that the meme stock traders population may have dwindled, but they're still there. And that to us is much more typical of sort of late cycle August coming into September, which is tends to be a dangerous month type of behavior.
That's interesting. You know, you mentioned the data at the top of the hour. Earlier in the week, it was ISM manufacturing prices paid, the 4th biggest month-on-month drop in the history of the series. Today, it's services, biggest monthly drop since 2017. We're going to start to hear a lot more people argue that Jackson Hole will be an opportunity for the Fed to truly pivot. You think that's also too optimistic?
Yeah, we do. Now, the positive, and we'll say that Ed Hyman and his team's surveys have shown conclusively that pricing power has started to turn. And that's a major positive in the battle against inflation. But there's clearly much more work to be done. And the Fed has really made it clear that the last thing that they want to do is get into a position where for some reason they have to cut rates subsequently in 2023 simply because the inflation problem may not have been cured. So there is more work to be done in terms of hiking. before we sound, more of an all clear, particularly for the equity markets.
So, Julian, given that backdrop and what you mentioned about where you think we are with regard to rates at this point in time, and the potential headwind that could provide for stocks, where should investors be putting their money, or do you recommend sitting in cash in this environment?
So the first thing investors do is and I've been listening to the last 20 minutes of CNBC, and the commonality has been the complexity of the environment and how emotions take over. This is a bear market. It has been a bear market. Emotions run much higher. What you need to do is you need to sit back and say to yourself, if in fact our view is right, that you retest the June lows at some point, are you a buyer of stocks at that point? Because you shouldn't be selling low and buying high. That argues for a larger than normal cash position, and something that you don't tend to do during secular bull markets, which is as the market runs higher, you want to trim some of your position. So again, you can be in a better position to buy weakness when it materializes.
I mean, he's not wrong. It's just, it sounds very like, it's like, man, come on, give us a chance to enjoy the rally a little bit. We are now officially above 318 on the QQQ. 318 is the level that we want to stay above. I think it's a very, very bullish level. It is, I mean, if you zoom out here, I think the chart does all the talking that you need to see right here. It is the 1, 2, 3, 4 marker here. We're breaking through it right now. It's possible that that time to trim will come where we get back to something crazy like a 61% retracement, a 78% retracement. If we continue to get some kind of rally, if we get a big move to the downside on CPI. But right now, this is an opportunity. I think an opportunity for if you're in margin debt, get out. This is a great opportunity to get out of margin debt. I don't think it makes sense to go heavily into margin. If somebody was like super, super excited to try to upside hedge, I think one thing that you could do is look for something that has relatively low volatility right now and buy some calls, but not much. Okay, cool. So, I mean, it's a great market day. Market's really happy. Let's take a quick look and see what yields are doing. That's a big deal. And then we'll have some big earnings at market close. Yields right now sitting at up again, 2.825, which is really interesting. The bond market yields, well, we've seen yields go up as this rally is happening, which is actually to some degree of what the Federal Reserve wants. They want to see yields go up. But I don't know. The Fed likes to, anytime we get these rallies, the Fed likes to come out and talk the market down. Anyway, time to dye my hair green again. I don't know. What do y'all think? Well, let me know in Discord by chatting it up. Go to metkevin.com/chat. You can tag me. I'm in there. I see the tags every day. So feel free to chat with me there. If you want to join the course member live stream, which will be happening at 10 a.m. this morning, and do some deep dives on some of the earnings that came out, go to metkevin.com/join. We'll also do some real estate analysis and answer your questions. So check it out. There's a coupon code Series A link below. Thanks so much for being here. We'll see you next one. Bye.